Welcome. In this video, Zbcn coin liquidity cleared. When is the attack? We will analyze it. Don't forget to subscribe and like. And please watch to the end to understand.
First of all, when we say that there is such an uptrend and that the price needs to break this trend, we are actually touching on a very important point in technical analysis. The concept of an uptrend means that the price has been moving upward for a long time. In other words, buyers are stronger in the market, and after each pullback, the price is pushed to a higher level. The existence of such a trend reinforces the confidence of market participants because buyers are willing to enter the market even at higher levels. However, at the same time, this uptrend also contains within itself a structure that will not last forever. Because by its very nature, every trend eventually gets exhausted, balances shift, and a new direction emerges. The statement that the uptrend needs to be broken actually signals that this long-term buying pressure will eventually be balanced out by sellers gaining strength, and that once the price slips below the trend line, a new story will begin. The necessity of the price breaking the trend is important not only technically, but also psychologically. Because after long-lasting uptrends, investors usually expect a correction or a pullback, and this can create strong selling waves once the trend is broken. The breaking of an uptrend is often an indicator of changing power dynamics in the market. That is, in a market long dominated by buyers, the involvement of sellers can cause the price to slide lower. This breakdown is not only limited to falling below the trend line, but it can also be supported by changes in trading volume, candlestick formations, and divergences in momentum indicators. Another important aspect of the price breaking the uptrend is that it triggers a search for a new direction in the market. After long rises, the breaking of the trend shows that sellers are stepping in and that buyers are no longer as strong as they used to be. In this case, investors see the trend break as a signal and adjust their strategies accordingly. For example, some investors start selling after the trend breaks, while others assume the decline will continue and take short positions. In any case, the breaking of the uptrend is a significant turning point in the market, because this break indicates not only that technical levels are changing, but also that market psychology has entered a different phase. This phase is often full of uncertainties, because once the uptrend is broken, investor confidence is shaken to some extent. That is why a trend break is one of the most critical moments in determining the future of price action. If we look at the breaking of an uptrend from another perspective, we can also see it as a kind of breathing process. Because when the price continuously makes higher highs and higher lows, it creates pressure on investors. Especially for those who enter the market later, seeing prices constantly rising can cause panic buying, which can lead to the market inflating in an unhealthy way. With the price breaking the uptrend, this excessive optimism is somewhat curbed. Investors realize that the market will not always rise, that there can be pullbacks from time to time, and this helps the market move into a more sustainable structure. Therefore, a trend break should not be seen solely as a negative development. On the contrary, this break contributes to the healthy progress of the market. Because if the price keeps rising continuously, after a point it no longer attracts new buyers. However, the drop that follows the break creates buying opportunities at more reasonable levels. When we say that the uptrend needs to be broken, we are focusing on one of the most important tools of technical analysis, the trend line. This line is drawn by connecting the past lows of the price, and the price staying above this line indicates that the uptrend is continuing. However, once the price falls below this line, the uptrend loses its validity. This gives us the signal that a new downtrend may begin, or at least that the long-lasting uptrend has ended. The breaking of the trend line usually causes investors to review their positions, because investors who carried positions confidently during the uptrend start selling after the break in order not to increase their losses. This strengthens the impact of the break and can cause the price to drop rapidly. Another consequence of the price breaking the uptrend is that it sets the stage for the formation of common technical patterns. For example, when the uptrend is broken, head and shoulders, double top, or similar bearish signals can appear. Such patterns increase investors' bearish expectations and strengthen selling pressure in the market. Therefore, the breaking of the uptrend is not just the price moving below a trend line, but also the beginning of new technical formations. This opens the doors to an entirely new era in the market, because in technical analysis, every break brings with it a new story. And this story becomes one of the strongest factors shaping investors' decisions. From a psychological standpoint, the breaking of an uptrend creates strong effects on investors, because people are usually optimistic during uptrends and are constantly expecting gains. But once the trend is broken, this optimism turns into concern. With this concern, many investors leave the market or sell to cut their losses. This also causes the price to decline more quickly. However, this process also holds opportunities, because once the price breaks the trend, panic selling occurs, and this panic can push the price below its true value. At this point, patient investors step in and can catch long-term opportunities. So, the breaking of the trend is not only the beginning of a decline, but also the birth of new opportunities. Saying that the uptrend needs to be broken is essentially accepting that the natural cycle of the market is at work, because every market move progresses in waves. Just as an uptrend does not last forever, a downtrend does not last forever. When the uptrend is broken, it means that a new balance-seeking process has begun in the market. And this balance-seeking process makes the market healthier in the long run. That is why investors should not see the breaking of the uptrend as merely a negative development. On the contrary, this break can be a sign of the market's restructuring and of a stronger rally in the future. In conclusion, the idea that the uptrend needs to be broken is a reflection of the naturalness and healthy functioning of the market. Although continuous price increases mean profits for investors in the short term, in the long term they are not sustainable. At some point, the price breaking this trend brings balance to the market, renews investor confidence, and paves the way for new opportunities. Therefore, when the uptrend is broken, this is not only the beginning of a decline, but also a sign of stronger moves ahead. That is why the emphasis on the necessity of the price breaking the uptrend reveals a very important truth not only from the perspective of technical analysis, but also in terms of the overall functioning and psychology of the market. But we cannot make decisions based only on trends, so let's take a look at the other metrics as well. Stay tuned.
When a bullish crossover occurs in the MACD indicator, it is generally considered one of the strongest technical signals indicating that the market is gaining upward momentum. This is because the MACD consists of two different lines, the MACD line and the signal line. These two lines track the relationship between the short-term and long-term moving averages of the price. When the short-term trend moves above the long-term trend, that is, when the MACD line crosses the signal line upward, it suggests that momentum in the price is strengthening. In a sense, this crossover shows market participants that buyers are entering the market more strongly while sellers are starting to lose control. Especially when this crossover occurs after a downtrend or a period of sideways consolidation, it is often seen as the first signal of an upward breakout. Following such a crossover, prices often experience a sudden surge. This is because most technical traders closely monitor the signals from the syndicator. At the moment of crossover, buy positions begin to increase, which can push the price upward quickly. The MACD bullish crossover is significant not only for short-term traders, but also for medium and long-term investors. This is because the signal indicates that the overall market trend is turning upward. For example, if the price has been consolidating or moving within a range, a MACD crossover confirms that this range has been broken and the trend is evolving in a new direction. This gives investors confidence since it shows that the market has now chosen a strong direction. This signal becomes even more meaningful when it is supported by volume. In other words, it's not only about the crossover of the lines, but also about whether buying volume increases at the same time, which indicates that the bullish move could be more sustainable. In technical analysis, volume is just as important as price, as it confirms the strength of the trend. When the MACD bullish crossover is accompanied by rising volume, it often signals not just a short-term bounce, but the beginning of a genuine rally. At this point, investors turn their attention to higher resistance levels. As prices start breaking through these barriers one by one, buying pressure grows while sellers are forced to retreat. This creates a chain reaction that pushes the market steadily upward. The psychological impact of MACD crossovers is also very significant. Many investors wait for this signal to make buying decisions. The fact that thousands of traders followed the same signal only amplifies its effect. It becomes almost a self-fulfilling prophecy. When the MACD gives a bullish crossover, investors collectively buy, which drives the price higher. The rising price attracts more buyers, and the cycle continues to expand. Thus, even a small crossover can have the power to trigger a major rally. Historically, large upward trends have often been preceded by the signal. According to the principle of historical repetition in technical analysis, when similar conditions occur, investors tend to act in the same way, leading to similar results. Another key point is how the MACD histogram develops during this process. At the moment of the bullish crossover, the histogram starts moving from the negative area into the positive zone. This visually confirms that market momentum is increasing. As the histogram bars grow longer, it signals that momentum is strengthening and prices are accelerating upward. Investors then feel confident not only in the current price movement, but also in the outlook for further momentum gains. This creates a psychological sense that the rally can last longer. The level at which the crossover occurs is also very important. If it happens below the zero line, it may indicate that the shift from a downtrend to an uptrend is just beginning. In this case, prices may still be recovering from lows, leaving significant upside potential. On the other hand, if the crossover occurs above the zero line, it signals that the existing uptrend is likely to strengthen further. In this scenario,
a short wick below the most recent low is generally considered a common and highly meaningful technical pattern in the market. This occurs because it can indicate that the price has cleared liquidity in that area. That is, stop-loss orders accumulated below that level have been triggered, allowing large players to collect liquidity and prepare to push the price upward. This movement is a clear reflection of market psychology. Many traders view the most recent low as a significant support level, so when the price dips below it, panic selling occurs, or stop-loss orders are triggered. At this point, large players step in and collect the liquidity without letting the price drop further, then guide the price upward. This movement is a clear reflection of market psychology. Many traders view the most recent low as a significant support level, so when the price dips below it, panic selling occurs, or stop-loss orders are triggered. At this point, large players step in and collect the liquidity without letting the price drop further, then guide the price upward. The key feature of this movement is that it appears to be a false breakout, often signaling that the market is on the verge of a major reversal. To understand this pattern, it's important to first focus on the concept of a wick. A wick occurs when the price tests a level on a candlestick chart but cannot hold that point and pulls back. If the wick extends below the most recent low, it indicates that the low has not actually been broken but only briefly tested. The fact that the wick does not close below the body, meaning the candle closes above the low, further confirms that this movement is a trap. In a true breakout, the price would not only wick down, but also close the candle below that level. Here, however, the price dips to collect liquidity and then reverses upward with strong buying pressure. Therefore, such wick movements are often seen as an early signal of a potential trend reversal. To explain liquidity more deeply, most traders place stop-loss orders at key levels. Particularly, there is a high concentration of stop orders below recent lows, as many traders believe if the price falls below this level, the trend is broken. This creates a liquidity pool below the most recent low. Large players, institutional investors, or whales capable of moving the market, target these pools. They push the price down to trigger stop-loss orders, effectively collecting sell orders. This selling pressure provides a buying opportunity for large players, allowing them to open positions at lower prices. At this stage, small investors lose while large players begin to profit. Afterward, the upward movement of the price signals the completion of this process. After such a wick formation, the likelihood of an upward move is quite high. The liquidity has been cleared, leaving no additional force to push the price downward. On the contrary, large purchases have been made at that level, increasing the probability of the price moving upward. One critical detail to watch is the depth of the wick. If the wick only dips slightly, it generally represents healthy liquidity collection. If it is very deep, however, it may indicate that the trend is genuinely being challenged. Nevertheless, in most cases, especially if the candle closes above the low, this is a sign of a reversal. Psychologically, this movement has a significant impact on investors. When the price dips below the most recent low, many traders panic, thinking the decline has started. Stop-loss orders are triggered, new sell orders come in, and a short-term chaos appears in the market. However, the rapid recovery shows that the panic selling was unnecessary. This indicates a strong presence of buyers. As confidence among traders is shaken, the price begins to rise, and those left behind, fearing missing out, start buying again. This further strengthens the upward movement. Such false breakouts are a natural part of the market and are known as stop hunts. Large players are often well aware where small investors place stop-loss orders. Their algorithms calculate these levels and push the price accordingly. Once liquidity is collected, the trend reverses. Experienced traders see these wick movements as opportunities because a wick below the lows typically points upward rather than downward. If this occurs on higher time frames, such as daily or weekly candles, it is an even stronger reversal signal. From a broader perspective, a wick below the low corrects market imbalance. Stop-loss orders accumulated there are cleared, reducing market pressure. The price is then ready to move upward. In a sense, the market breathes before rising, discards excess, and proceeds stronger. After this movement, sharp upward moves often follow, because few obstacles remain to block the upward direction. On the contrary, new buyers have entered, and the foundation for a continued uptrend is established. In conclusion, a wick forming briefly below the most recent low, followed by a rapid recovery, can be considered a very strong technical signal. It indicates that liquidity has been cleared, a stop hunt has occurred, and large players have filled positions. After this stage, the likelihood of an upward move is quite high. Of course, nothing in the market is 100% certain, but historically, this pattern has repeatedly worked and signaled strong reversals. Investors who read these movements correctly, avoid panicking, and seize the opportunity can benefit significantly. These false breakouts often mark the beginning of real upward moves, offering substantial gains to patient investors.
Yes, friends. I hope you liked the video. If you subscribe to my channel and like the video, more videos will be coming. Be careful in your investments, analyze the risks correctly, and always take strategic steps. I will be with you with different analyses, investment opportunities, and technical information in my videos. I wish you all a lot of profit. See you soon.